Karen, how are you feeling about traditional automakers?
Not good, not good. It's just funny, though, Gene. Look at the brain on you, Harvard girl. You impressed him. I mean, not surprising to all of us who know you. But no, not good. They're just way ahead. And, the valuation chasm has gotten even bigger, if that's even possible mathematically at some point. I would think it can't be possible any longer. But as it should, that is the direction it should go, no doubt.
What's up, people? I'm back for another one. My name is Tevi, and this channel is dedicated to my investment journey, along with coverage on crypto, Tesla, NEO, Virgin Galactic, and ChargePoint. Come for the information and stay for the perspective. So you heard the intro clip, you saw the price target in the title. We'll get back to that a bit later. But for now, you probably realize and understand that Tesla just had their best quarter since inception. That is why, despite the entire stock market losing big time this week, based on the commentary from the Fed, Tesla still managed to hold on to 2.04% gain after the massive pop that you see here post-earning. And if you're not sure what I'm referring to, both Chairman Powell and the San Francisco Fed President, Mary Daly, were out this week basically officially confirming that 0.50 percentage point rate hike was coming at their upcoming May 4th meeting. You could argue, didn't we already know that? Yes, we did. But you gotta realize that a lot of the trading is based on algorithms, right? And certain keywords or events automatically trigger sell orders. Fed meetings and rate hikes fall in that category. Anyways, this coming week, all big cap tech companies report, which will set the tone for where the market goes from here. In my opinion, higher, though it will be a bumpy road, as I said before. With that in mind, let's talk about how Tesla crushed it this quarter, right? And further flexed on the rest of the automotive industry, demonstrating once again why they've won the decade and there will be no catching up from legacy auto anytime soon. As always, this isn't to be taken as financial advice. I'm not a financial advisor. This is my personal approach to investing and the thought process behind it. That said, I'd recommend watching all the way through so that you don't miss out on any pertinent information I'll be sharing. Drop this video a like if you haven't already and hit that subscribe button. Those are two easy ways to show your support to the channel and help it grow if you appreciate the content. All right, let's get into it. It was just 2 weeks ago that the Q1 delivery numbers were released. Based on those, it was already clear that Tesla was going to have a record quarter, right? But I don't think anyone, including myself, expected this level of outperformance. We already know that Tesla is able to write new codes, giving them the flexibility to use and repurpose any chip available on the market. That is a capability that no one else currently has. The competition simply doesn't have the know-how, right? That's one of the big reasons, despite all the shortages, Tesla has been able to navigate the environment better than the competition and thrive. One of the points that Elon made during the call is that despite the current growth that Tesla is experiencing, they're just now about to start truly scaling massively. Take a look at his trailing 12-month chart reflecting vehicle deliveries, operating cash flow versus free cash flow, and net income versus adjusted earnings. Notice anything? Well, that step change at the end of 2020 into Q1 2021 coincides with the opening of Giga Shanghai. That massive shift in deliveries as the year goes on is a result of a single additional factory ramping through 2021, right? Are you starting to understand the implications of 2 new factories coming online this year? The real story here is the manufacturing efficiency Tesla is able to achieve by simplifying the design by fully casting the front and rear section of Model 3 and Y. What does that mean for their margins? Well, John McNeil, who previously served as one of the Tesla board presidents, shared his thoughts post-earning call on that very question. Take a listen.
Margins also, the sales number just nominally, and the growth was, almost out of this world, almost like a SpaceX. But the margins
during
the legacy, double the legacy producers, the margins.
You're absolutely right. Like during my years at Tesla, I can't tell you how hard it is to double a business at this scale in hardware. And Tesla's been doing this for years, and now they're at this scale still growing at 87%. And as you said, their profit tripled to $1.1 billion, but their gross profit margin at 30% ex credits is double GM and Ford's. So they're not only executing at the top line, they're executing at the bottom line as well, which is really impressive.
I mean, increasing automotive revenue 87% year over year is super impressive. But to really grasp how much more efficient Tesla is, you need to look at their gross margin against the competition. Clear outperformance against Ford and GM, as John pointed out, but it's not just them. Take a look at this chart. There is a clear distinction on where Tesla is versus everyone else. And as they continue to innovate on the manufacturing process, that gap will just keep growing. Elon also reiterated that they expect to release a fully autonomous robotaxi vehicle in 2024, and as he said, no pedals, no steering wheel. He had first announced this at the opening of Giga Texas, if you recall. I think John does a great job at framing the importance of this particular product, but his last comments is probably the most important one. Take a listen.
I've seen this movie up close during my time at Lyft, and the robotaxi challenge is a very hard challenge. However, what a lot of people don't understand is a robotaxi is worth about $250,000 of profit. So if they're successful, that completely changes the car business from a one-time sale where you're making $8,000 to $10,000 of profit per car, and you're producing a car that can generate 31 times the profit. That's a goal. What a lot of people don't understand is Elon, when he makes these statements in public, is largely intending to motivate his internal team and point them at the next hill or the next horizon. But I think for long-term investors, that's not where I would place the value of this company. We're in the very early innings of electric vehicles. This company can grow to be 5 or 6 times its size over the next 10 years just in electric vehicles. X robotaxis, X robots. It's a very, very attractive business.
Again, I keep telling you this. Stock of the decade. And we're not even talking about Megapack, Solo Roof with residential energy storage, or even Tesla insurance yet, right? The potential here is just massive for long-term investors. I'll attach the full investor presentation if you want to go read through it. But the reason Tesla says here that they have sufficient liquidity to fund the project roadmap is because they are currently sitting on a war chest of $18 billion in cash or cash equivalents and have less than $100 million in debt. $18 billion in cash, $100 million in debt. This is mind-blowing for a company with $1 trillion market cap. And keep in mind, this is before they split the stock and more capital flows in through that mechanism. Just wow. Now, they didn't provide any more details on stock split, so we'll just have to wait for that at a later date. But the bottom line here is this. You can buy more now or wait till they split and buy more then with a lower entry point. Either way, having some Tesla in your portfolio for the next 8 to 10 years and even beyond that is probably a good idea. Just saying. Now, we all know I'm biased, so let's switch gears and give you some visibility to how Wall Street analysts are rating the stock post-earning. The spectrum is always entertaining to look at. We have 28 analysts covering the stock with 16 buys, 7 holds, and 5 sell ratings. Over the next 12 months, the average price target is $1,060.89. We're basically there now. On the high end, we could see $1,580, and the low end comes in at $67. That $67, by the way, comes courtesy of none other than Gordon Johnson, who is ranked virtually dead last in the analyst world. Do not listen to Gordon. Just don't. Now, beyond analysts, you also have superstar fund manager Cathie Woods, who just dropped her new price target on Tesla, upping the NT to $4,600 by 2026. This is on the back of expectations that robotaxi hits in 2024, as Elon guided during the call. Of course, that number will have to be adjusted post-split, but that's basically 44% year-over-year improvements between now and 2026. Another way to think about this is this. If you were able to acquire 1,000 shares of Tesla total post-split, those could be worth $500,000 by 2026. Food for thoughts. For you, for me, that's the goal. And on that note, I'll leave it here for today. Don't forget to drop this video a like if it helped you gain a new perspective and share with others who you think could benefit from it. For my newcomers, subscribe and don't forget to ring the notification bell so that you too can stay in the know. I'll be back on Sunday and as time allows during the week, here and there. Thank you for watching. Stay humble, hustle hard, and I'll see you in the next one.